Another round of bank recapitalization is here. For the next 2 years, between April 1, 2024 and March 31, 2026, the nation's 25 commercial and 6 merchant banks are expected to shore up their minimum share capital by as much as 100% in some categories. The CBN said all international banks should move their capital to a minimum of 500 billion naira. National banks to a minimum of 200 billion, regional banks, merchant banks to 20 billion for non-interest banks operating nationally and 10 billion for those operating regionally. To achieve this, the banks will adopt one or a combination of these 3 options: inject fresh equity capital through private placement, rights issue and or offer for subscription, mergers and acquisition, and or upgrade or downgrade of license of authorization. Well, to make sense of this, I'm joined in the studio by Steve Nwachukwu. He is an economist, a financial analyst, and the lead researcher at Steward Asset Management Limited. Mr. Nwachukwu, thank you for coming.
Thanks for having me. My pleasure.
Right. So banking recapitalization, there was one in 2005. It was from 2 billion to 25 billion. Now we're talking about 500 billion, 200 billion, 50 billion, mega money now. We've come a long way. It's a leap, right?
Yes, it's quite a good one. I think in all aspects, recapitalization is needed. And what's the essence of recapitalization? To make the banks more stronger, to make the banks more liquid, and make the banks more also. You know, our credit to GDP, national credit to GDP is around 14%. So when you have much liquid, you can be able to lend to both private sector, retailers, and entrepreneurs. So it's quite a good one that we are having this very push to recapitalize and make our commercial bank more capital base so that they can perform other larger functions. It's quite a good one.
So some economics argue that the problem of fractional reserve banking in Nigeria is not only low capital base, but also the CBN's high cash reserve ratio policy. Do you agree with that?
Of course, that's why I kick against the Cardosa-led team and his team at the CBN. When you have your cash reserve ratio somewhere above or around 45%, and you also have a liquidity ratio at 30%, it means that you've taken chunk of 75% of workable monies that the banks can literally use to support the economy, to support this very low credit to GDP we have, which is around 14%, while we should be having something above 30, 35 to 40% to give that even growth that we needed. So having 75% already chunk off from the commercial bank is not a good one, and I'm very sure with time it will actually retrieve or reverse most of these decisions and make it more flexible for banks to operate. You're
confident it will be reversed? Do you know about any meetings or discussions in regard to that?
You know one thing about policies. Policies are well tested. They will be having the feedback from us who are the analysts who look at these policies, and from also the commercial banks. What are the evidence within them these very few months you have applied this? Were they able to operate optimally? These are the things that CBN will look at, and definitely they will see every reason to revise it.
Okay, so depending on where the banks raise the capital from the capital markets, this has the potential to crowd out other businesses seeking capital. Do you agree with that?
Of course, it's one of the loopholes about this very exercise of the Central Bank of Nigeria. Remember that the 500 billion, 250 billion is about 900% increase, 700% increase, and 400% increase respectively. So what it simply means that when you are checking about over 4.6 or 4.3 trillion at the same time, imagine the commercial bank. So when you are channeling such kind of flow of money only to the financial sector, it's going to crowd that, it's going to cause for liquidity crunch. Why do I say so? Good percentage of money, credit facilities that goes out to businesses and entrepreneurs naturally don't come from the commercial official or commercial banks. perhaps we have something we call alternate credit system, where, for instance, when you have some proposals and you hit the banks and the banks set out their standards and you couldn't make it, you run down to your uncle, you run down to your cousin, you run down to businessman in your community, or even run down to town union, you know, those monies they give to you are outside the financial system, credit system. Correct. So what it means, when you do this exercise and this 4 trillion is heading to this place, most of these monies are saved monies or idle money over years. So when they push this money to these commercial banks, there won't be that opportunity again for such entrepreneurs, for such businesses, for such of your clients or for such of your colleagues that will come for, can you borrow me 50K? In the end of the month, I'm going to give you. So such money will be wiped away from the system because everybody will be racing to participate because the banks will be coming with some lucrative offers. So that's the danger, the liquidity crunch that is looming.
So yes, liquidity crunch, it will exacerbate, low demand in goods and services, leading to shutdown of businesses and the recessionary economy. Do you also share that? Can you expatiate on that?
I will not agree to that extent that is going to bring down the slowdown the economy, but it substantially is going to affect the credit system facility in the nation. Like I said, the alternate, which constitute more than 10–15%. Most companies don't go to banks. Most individuals don't go to banks to access some of these funds. They go to their friends. Can you give me 10 million? Can you give me 20 million? Can you give me 50? I'm going to give you next time. So by the time these very idle funds that easily can lay hand to these entrepreneurs are channeled, because what actually happens during this exercise is that most of these funds that we're chasing after these shares through public offer or through right issues will be idle funds. Funds that have been saved over years. When you crowd them out, when you liquidate them, when you take them off, it means they will not be available for such individual, for such uncles that you can easily run to, for such development union, for such friends that you usually can ask for 200, for 300, because you have used the saved money over years to participate in this very commercial. So that's why we are looking at the government or the CBN segmenting this exercise. 4 trillion moving into the financial sector at the same time is going to crowd out these very resources I talked about, which cannot, these individuals cannot literally move to commercial bank and access these funds. So it's very important that CBN understands this and have this exercise done in trenches. Like I said earlier, nothing stops you doing it 300%. Next 4 years or 3 years, you do another 300%. Doing it in a sequence or in a trenches, giving room so that this very money, because all is not about government or official, the informal sector is also there to be a sixth. So policies should also accommodate such kind of activities that is not official, but they are going on. As we are talking now, somebody is in someone's house, knocking at the door, please, can you borrow me 200,000 naira? I'll give to you in the next 2 weeks. These are the kind of money that easily can reach out to those individuals. By the time this exercise comes, these individuals will participate, will do such money in this exercise, crowding out these very little resources available to take care of these businesses I talked about. Right. Most affected will be the entrepreneurs.
Right. In spite of all that you have said, how crucial is it for banks to be healthy? And how would you rate the health of our banks in Nigeria?
More than crucial. If there is anything like 101%, the financial system stability is paramount, both to CBN as a policymaker and to Nigeria as a nation. So we need that level of sanity. We need that level of stability of our financial system. So what actually CBN needed to do beyond this very recapitalization is to make sure that the issues around the access to credit and also credit to GDP is well improved. There is no way you walk down to commercial banks if actually after this exercise you have these trillions available with the commercial banks and you still go there, they will still be asking for your mother's head as collateral. So government needs to deliberately lower most of these criteria or prerequisites for individuals, entrepreneurs to access this fund. Otherwise, by the time you put this money to the banks and Nigerians cannot still access through the banks, it means it's still going to cause another problem for the economy, which means that that liquid crunch that we are talking about that will exist in the informal sector will now extend to the formal sector. Like I said, we have 14% credit to GDP, which is one of the lowest. We need something above 20, 25 to 30% to grow the economy.
Right. Let's stay on CBN as a regulator. Are you impressed as an economist with what CBN has done over the years? Has it been regulating properly, or is it in bed with banks? And how does that impact the economy?
Of course, I will not say they've not been putting up good policies. You know, most of these policies are try and error. You put out something, you look at it, you weigh it, and you reverse it. That's why there is that opportunity of the monetary policy decisions, so that they can think with those numbers and the rest. So I will say for sure, yes, CBN has been doing their best to actually make or call for that stability we need in the financial sector. Are those stringent measures good enough to keep the banks on their toes? I think they have been doing their best. That's why we've not been having issues of liquidation or issue of the collapse or bankruptcy of the bank. So as long as we continue to see some levels of intervention and level of improvement like we are doing now, the recapitalization is quite good exercise. But the strength at which CBN is going on this exercise is where I have issue. Like I said, nothing stops CBN to do a 300 billion recapitalization for the international cadre or authorization threshold and do something around 150 or 120 or 130. That will still give that sense of stability needed than to crowd out these very resources. You can also do it in trenches, in the sense that you have a 24 months. You can extend it to 48 months, whereby in 2 years' time you do 300%. In another 2 years, you do another 300 or 400% and complete this 900%, like I said earlier, in the 500 billion, which is that's actually the representation of the increase. 900% in the 500 billion and 700% in the 200% in the 200 billion threshold, and the 50 billion is around 200 or 400%. So CBN can actually lower it and do it in trenches or in sequence, so that it will not totally crowd out, except there is an existing measures to make sure that 70 to 75% of these funds are raised from international investors. That's the only way it will be good for our economy. But if you allow these banks to put up a lucrative price for their shares, they will crowd out all available funds.
Mr. Steve Nwachukwu, economist, thank you so much for joining us on Arise Prime Time.
Always my pleasure.